I met with the SEC, the Senate Banking Committee, and said, look, the last several years, we've probably seen 300 or 400 balance sheets that don't balance, and 200 or 300 income statements that don't add up. These are not rounding errors. There's major stuff there. Their reaction, you want to put more capital into a business that loses money or less? These are very fundamental and simple questions that I think too many investors have forgotten in pursuit of the MOMO. They don't pay attention to it. I think we're entering a golden age of the stock market that we haven't seen probably in a couple of decades, where capital is going to be allocated to where it's most deserved.
All right, folks, welcome to Investing for Beginners podcast. Today, we're going to have a fun show. We have somebody very special joining us today. We have David Traynor, who is the founder at New Constructs. He's also the heavyweight champion of the value investing world. And so we're going to have some fun today. We're going to talk a lot about finance, earnings, and all kinds of great stuff. So David, thank you very much for taking time out of your busy day to join us today. We really appreciate it.
My pleasure. I'm glad to be here. I think the work that you guys do is great, and I'm excited to join you.
Awesome. So let's start off with earnings has been upon us for a little while. What is your take on what's going on with the market and earnings?
Meet the new boss, same as the old boss. It's commercial season. It's like the Super Bowl almost, 4 times a year, where there's all kinds of whatever crazy stuff going on, but not a lot of substance. Mm-hmm. Look, I got my start on Wall Street before the tech bubble, and I've only seen, I think, the quality of research go down for almost 30 years. And I don't think that this earnings season was any different. You see some stocks, they beat, the stock goes down. Some stocks miss, the stock still goes up. There's not really much sense to it all. There never has been. If you know what goes on Wall Street, you know that Wall Street analysts play a game. Stocks they like, they have extra low estimates. I learned this firsthand when I was first on Wall Street. They said, oh, you know how it works, David. If you like a stock, you put a low number out there because you want the stocks you like to go up. Well, how do they go up? They go up because they beat the number. So you have low estimates for the companies you like. And obviously, the ones you don't like, you have a higher estimate. But so, yeah, I've really not paid any attention to whether or not they beat or miss by a penny, right? Does that matter? Is it consequential to the underlying economics of the business? No, it's noise. It's just meant to draw more people in, just like garish videos on Instagram or whatever. If it bleeds, it leads. So the media has never gotten paid for writing nothing. So they're going to do what they can to draw you in, and earnings is just another way to do that.
So true.
Yeah. When you say underlying economics of the business and kind of the research that goes behind it, I'm a very happy user of you guys' platform, and I know there's so many awesome features on there. But break it down for somebody who's never seen it, isn't aware of your research. When you think of underlying economics of a business, what does that really mean to you?
First and foremost, it's return on invested capital. That's just, I think, how I found you guys. You are talking about that. I'm like, here's the people who understand what the truth means. And then really it's economic earnings, and that's return on capital minus the cost of capital times invested capital. Now, these formulas are pretty well known. These terms are very well known over the years. Have been written about in multiple books for a long time. The concepts aren't too difficult, right? Economic earnings is really, it's just the comprehensive earnings of the business, and its main improvement over accounting earnings is that it takes into account the equity cost of capital. I remember Bennett Stewart created the term EVA, which is just another term for economic earnings, saying that accounting earnings is like playing tennis without a net. You need to understand the full picture. And that concept for me, when it comes to economic earnings, I take it very seriously. I think it's not just that you want to take into account the balance sheet. I think it's that you want to take into account the entire financial picture, the whole filing, not just the pro forma number, not just the accounting GAAP number, not just the balance sheet, not just the cash flow statement. Wall Street and the rest of the media are always trying to get you to go to a shortcut. They want to keep it easy. Well, guess what? Hard work or good research is not easy. So for me, economic earnings also means going through all financial statements and the footnotes, especially footnotes, because so much good data goes to hide in the footnotes. And if you take into account the footnotes, then your measure of return on invested capital, your measure of economic earnings is likely to be very different than without it.
So when you're talking about economic earnings, and you made a comment about it's kind of like trying to figure it out without, playing tennis without a net. What exactly do you mean by that?
I mean that accounting earnings are overlooking a significant amount of what it takes to run a business, in particular the equity capital. We're talking about stock, so there's a lot of equity capital, and so accounting earnings ignore the cost of equity capital. And so showing good earnings or accounting earnings is a lot easier. It's like playing tennis without a net. It's easy to do when you get to ignore such a big percentage of the balance sheet. I think that's what the metaphor is meant to portray.
Okay, that makes sense.
So this idea that not all growth is, that some growth can be not as valuable as others. Can you touch on that and how that's why economic earnings is better than accounting earnings?
Yeah, one of my first little projects when I got to Wall Street, Michael Mobison was my boss. And so I built one of those models that proves that growing the business when the return on capital is less than the cost of capital actually destroys value. And there's a little chart that he's shown in presentations forever. It's in the Expectations Investing book. It's probably in a lot of places. I know it's on our website, but it's a little chart that has earnings growth across the top, 5, 10, 15%. And then you've got return on capital versus cost of capital, like -5, 0, +5. And then it shows PEs in the middle. And in the far bottom corner, where you've got high returns on capital and high growth, you've got the highest PE. And these are shortcuts, right? It's just a way to sort of demonstrate. I don't really believe in PEs either, but the point is match high growth with high return on capital. That's value creating. However, when you match growth with any return on capital, the PE gets more negative the faster you grow. It makes sense. You're growing a bad business, you're growing a bad thing. And so return on capital versus cost of capital is the most important question that any leader of a company should answer every day. What am I doing every day to maximize my return on capital? And am I always making decisions that allocate capital to endeavors that earn a return greater than the cost of capital? If they're not doing that, they shouldn't have the job, in my opinion. Right? The purpose of the capital markets is to allocate capital to its highest and best use. Therefore, the agents of investor capital should be thinking always about how to maximize return on invested capital. So that's I think what you're getting at there, Andrew, right? Is that if you're growing the business when return on capital is below the cost of capital, you're destroying value.
Yeah.
That's the takeaway. Do you want to put more capital into a business that loses money or less? These are very fundamental and simple questions that I think too many investors have forgotten in pursuit of the MOMO, YOLO, meme trade. They don't pay attention to it. And I think there's going to be some real pain. And I think it's going to happen this year. I think this is a year where we're going to see a reset on how the capital markets work.
Have you noticed, like, over time that there's been periods similar to this, or is this something that is just a little bit like, is this like the bottom, like such an extreme of an ignoring of fundamental analysis and things like that?
Yeah, I mean, it's happened a couple of other times. For sure, the tech bubble, the global financial crisis, things were getting nutty. And I think that 2021, when all those crazy IPOs like DoorDash and Carvana and Beyond Meat came out, that was nutty. And we had a bit of correction. And then, but the last like 8 or 9 months, it's been super nutty. And so much of it you can see is 100% tied to liquidity, right? When the Fed is growing its balance sheet and liquidity is rising, there's just a lot of loose money to chase after returns. Just like you go to Vegas and you got $1,000 in your pocket. How much you going to gamble, Andrew, Dave, versus $10? You're just going to gamble more, right?
Mm-hmm.
So people do, and people forgotten that the market is not really a speculative tool; it's an investing tool. So we've seen it's been nutty. This feels among the most nutty, but I always like to go back and look at the charts, and there's certain metrics during the tech bubble that are, I think, about the same or maybe even a little worse than what we see now. So it's been this bad before. I think it's difficult to figure out if and when it's going to change, but I think that under a new regime that's going out and breaking a lot of stuff, and I just feel like this might be the time when the markets get reset. And I think it'd be smart for somebody who tracks the market. I don't know that Trump always makes this decisions because they're what's smart, but I think for the stuff he pays attention to, like the stock market, if he's going to go and make a lot of changes, he needs to do it now so that the market can be on a rise in a couple of years when we're doing midterms, and he can continue to have influence in Congress. So he's got to get that over with sooner rather than later if he wants to go out on a high note, which I know he does. So he can say he's in the greatest of all time, right? The heavyweight champion of presidency. So that's sort of my little pet theory. It's not very scientific, but that's my theory.
So can we go back and talk a little bit about ROIC and WACC and our cost of capital and what that means to you and how people should think about it?
Yes, I've been thinking about this for 30 years now. My first job was executive compensation consulting, and we would build economic earnings models for boards of directors and go to them and say, look, whatever you do, don't pay your executives based on accounting earnings, because you can grow accounting earnings while running the business into the ground. And one of the biggest knocks on all this analysis and almost all rigorous analysis, like, oh, you got to have all these assumptions in there in order to get to a number, and then it's all about assumptions. Well, you should see the assumptions that are baked into all the other Wall Street estimates and models, right? I mean, those are all assumptions too. You can't get away from it. The thing about cost of capital is just keep it simple. That means that I've looked at other ways of doing it. You've got capital asset pricing model. We'll start with cost of equity, because that's the more difficult one. The cost of equity portion of the cost of capital. You got arbitrage pricing theory and capital asset pricing model. I've looked at both, and I remember talking about this with Mobison, because I really didn't want to be. It was my job to build out these models for Credit Suisse back before the tech bubble, and I really just didn't want to have to worry about cost of equity. I just wanted to outsource it. So I was pushing really hard for us to buy a subscription to the APT model. It was a firm that put out this cost of equity. We use it at the compensation firm I'd worked for before. And he was like, he just pushed back, and he's like, David, do you get that different a number if you go with some fancy system versus just CAPM? And I was like, no, you don't. He goes, well, I just don't think we can justify it. So what's the real problem then if you're breaking down CAPM into its components? Risk-free rate, pretty straightforward. That's easy. We can pull that. You either use a 30-year, 10-year, whatever. You call that your risk-free rate. And then you've got the expected market return. And that one, you can get really fancy about that, try to predict where the market's going to go. And I say, don't do that. Just go with some reasonable number. And then really at the end of the day, we look at the equity risk premium, which is the difference between the expected market return and the equity risk premium. And we try to kind of keep that consistent. So the expected market return can change a bunch, but we keep the equity risk premium consistent. And then the really crazy one is beta, right? Because beta is supposed to account for all systematic risk. And it's silly to assume that any one number could capture or carry that much analytical value. And the biggest mistake people make with beta is trying to be too precise. And because if you're going to go look up your beta, and I tried this when I was in Wall Street, you look up the beta on Bloomberg. Oh, it's got a negative 2.5 beta. Okay, now your cost of capital is 2% or something, or negative 1%. Stupid number, right? Or it's got an 8 beta. Now your cost of capital is 25. All right. So you got it. What we do is we limit beta. So the lowest beta in our system for any company is 0.5. The highest is 2. And then we go by sector, and we basically do some relative volatility analysis. And And utilities and energy stocks or utilities and certain energy stocks get like a 0.5 beta. Startup stocks or whatever, they're at the 2. So it all makes a lot of logical sense, and it works on a spectrum like that, but it's limited. And then the equity risk premium rarely changes. Because at the end of the day, when you're looking at economic earnings from one period to the next, you don't want to like be going through your database and go, oh, look at these guys. There's a big increase in economic earnings. And you go to do all the work, you look at it and you go, oh, yeah, that's because their beta went down. It's like, no, I'm not picking stocks on cost of capital. Right. So you need to have that hurdle rate in place. You need to have a reasonable proxy for the cost of equity capital, keeping in mind you're never going to get it exactly right. It should be, the differences between companies should be a little bit different based on volatility of the stock. That's fair. But you have it in there, and then you run your analytics, and you don't let the cost of capital get in the way of a good analysis. And the good analysis is on your return on capital, your NOPAT, your invested capital. That's where the work's supposed to be done. Just keep WACC reasonable, but mostly on the back burner, so you don't think about it or worry about it much. And that's the way we handle it.
It's a way that makes a lot of sense to me, and it's obvious you've tried. It's a ratio that's not just theory, but you've applied it, and so you're aware of where it can go wrong, and especially with the beta. When you talk about economic earnings and accounting earnings, are you more concerned with the gap between the two or trend lines? Like what does it for you there?
It's got to be both. It's got to be both. For example, the stocks that make our most dangerous stock list. We have a model portfolio called the most dangerous stocks. It's been around since around 2005. A great outperformer. We have another one called most attractive stocks. It also has done great. But to be on the most dangerous stocks list, you have to have what we call misleading earnings, and that's where your economic earnings are positive. I'm sorry, your accounting earnings are positive and rising, while the economic earnings are negative and declining. So you're getting a dispersion, right? That's a big deal. To me, it's more the direction. If I had to choose one, the direction. If they're spreading, that's a bad thing. If they're if they're moving in different directions, I think that's a little bit more alarming than the overall absolute difference. So that's because a lot of times I see companies and there's a difference between accounting and economic earnings, and there's been a difference for a long time, and it just kind of stays there. It's when there are inflections. On the other side of it, when economic earnings are higher than accounting earnings, that's like a super good sign. Like we pick stocks based on that alone sometimes. Like we've got some special bundles that we do, like stock picking ideas, promotions we do where we focus on that because we don't have a model portfolio for that even. It's just a new thing we back tested. When economic earnings are greater than accounting earnings and the rating is attractive or better, those stocks in back test can do really well, like really well. Like that's like a secret. I think direction is important, but you can't ignore the degree of difference as well.
How does that even happen? How can it be higher? Is
Oh,
it because net income suppressed or something?
Yeah, that's typically what happens. It's got to be a capital efficient business. You're going to see it. So that almost always you're going to see high returns on capital.
Mm.
And one of the biggest adjustments we make is for unusual items on the numerator in the income statement. That's what the footnotes mostly get, or where we get the coolest stuff is unusual gains and losses. And there's a lot of unusual losses that we often pull out that can make the economic earnings look better than accounting earnings. It does not happen often, but a couple that have been awesome performers over the years is, I think this happened with, I don't remember the date, but Domino's, we noticed Domino's Pizza, they were kind of a poster child of that for a long time ago. Why am I not finding the ticker for that, guys?
DPZ.
DPZ. I put in DMZ and it gave me some. So, yeah, I think we pointed it out like in 2000 and I don't remember, 2015 or 16, we pointed out. Accenture was another one that was like a really high return on invested capital business, and that was around the same time. And those stocks went on to have super performance. There's a few others that we a long time ago called. There was a few, a handful. I think we did 3 bundles, like 6, 9, and 12 stocks. We pointed out last September, October, and those have meaningfully outperformed. So it is rare, Andrew. It's a good question. How does that happen? It's typically an understated net income has to be involved.
So you mentioned the footnotes. And now we're getting into a whole nother fun topic. So when you say there's information in the footnotes, what do you mean? And can you give some examples?
Yeah. So before I did the executive compensation consulting job, I was an auditor for a short amount of time. And I remember the first time I found an issue in some financial statements. I went to my manager, and I'll never forget, she said, "David, you know what this is?" And she pulled out this file, and it had like CYA on it. She goes, took the paper, she put it in there. She goes, "You know what it says below every single income statement in the published financial statements?" I was like, "No." She goes, "It said read the footnotes." She goes, "This is for the footnotes." And I'll never forget that. I'm like, "Oh my God." So what you're saying is that you are, as an auditor, you're signing off on, hey, whatever's in the income statement, whatever's in the balance sheet, whatever's in the cash flow statement, doesn't matter, because you tell everybody that this data is only as good if you take into account what's also in the footnotes. And I was like, bam. I mean, okay, wow, all right. And so that's what sort of led me down this road eventually to the executive compensation consulting group, which I was super interested in going and looking at all that data. Because to be honest, my experience in college around finance was really poor. Like I got just like it's just terrible. I didn't even believe what I was being taught. It was so incomplete. And so like, I need to figure this out. And then so, yeah, that really got me focused on footnotes. And I went and started looking, and there's all these things you can see in the footnotes that are clearly super important, but overlooked. And let me say, corporate America and Wall Street have figured that out. When I was first doing this work in the mid 1990s, annual reports, quarterly reports were maybe 10 to 15 pages long. A really long one was 30. You know how long they are now on average?
110, 120 pages.
200. 250 on average, bro. I mean, that's when you look at all of them. We look at a lot of them. Like we see some that are 2,000. And why is that? Well, because they're trying to intimidate people from reading them. No question. As someone who's done this work for 25 years, there is no question that 98, 99% of all companies are in the business of obfuscating financial performance. I saw the same thing in my interactions with FASB, and just how brainwashed they are into like, oh, it's hard for the company to disclose this data. Oh, so we shouldn't be hard on them. Like, what? And then in talking to companies and finding out their excuses, when I would go to the meetings with FASB around, oh, so Intel doesn't want to disclose this information. I'm like, what's their excuse? Oh, well, it's not easy for them to do that. I'm like, what do you mean? Either they don't have it or they just don't want to do it. Because if they have it, well, then they should just share it. But if they don't have it, well, that's news too. Especially when it comes to derivatives, which is where we were getting all the pushback. Oh, it's too much work for us to do all this disclosure on derivatives. What? So either you're not doing the work, in which case, oh my God, that's terrifying. That's material information. You don't even know what your own derivatives portfolio looks like. Or you do know what it looks like and you just don't want to share it. It's one of those two. Mm-hmm. And so the takeaway is they're in the business of obfuscation. And that's because most of the time that works to their favor. If they can control the narrative, and who doesn't want to control the narrative? They're in a power position. They control the narrative by controlling earnings. And that means making them look better when markets look good and making them look worse when market looks bad. They do both.
Yeah, I saw an example of that recently. Dave showed me in an annual report about a management compensation, and they have to put the CEO pay ratio. And so this CEO ended up, it was like one year it was like 2% of revenues, another year was 3% of revenues, just this guy's compensation. And when Dave pointed this out to me and he showed me where the CEO pay ratio was, every other company has it like in numerical, oh, the CEO pay ratio is 120 or something, in numbers. And this, whoever had written that report typed it out. So like, you can't find it if you're trying to skim. They type it out. So if you're not intentionally reading it, you just, oh, I guess I never did learn what that CEO pay ratio is. It's nuts.
Oh my gosh, I can't tell you. I mean, then there's the Tesla filings where they don't even put it into a document. They just put pictures into the filing. So it's a JPEG. So it's really even more difficult. Right? I mean, I can't. I mean, we got millions of those examples that I've seen, and I mean, it didn't take me long. I mean, I can't remember when I first. I mean, it wasn't long. You only have to read like 5 or 6 annual reports or track 1 or 2 companies over a couple of years, and you'll see how much difference there is from even for one company from one quarterly report to the next. And as having been an auditor, I know like the easy thing to do is copy and paste that stuff. Like you start with the working papers from the last period, and you build on that. The changes that they make it's more work, and it's intentional, and it makes it difficult to do exactly what you're talking about, Andrew. Like you found something once, you're like, oh, push the rock up the hill. Okay, great. All right, that should be easy going forward. No, they're going to find a new way to hide it. And sometimes they don't even disclose it. We see options tables since we're covering thousands of companies since back to 1998. And I've always built the system so that it breaks if it doesn't have all the data or if certain checks aren't in place. Like I've always said, like we pull the emergency brake and the company goes offline. There's no model, there's no nothing. If the system doesn't agree that everything's perfect, and we've got probably 10,000 different checks that we're going through to make sure everything's just right. And one of the things we had to relax if we wanted to cover a lot of companies was what to do when certain required disclosures go missing. Let's talk about operating leases. Sometimes it's in the queue, sometimes it's not. So if we were to assume that, they didn't disclose operating leases this quarter because maybe they don't have any, you know how much that would mess up your free cash flow model? Because most companies, when they have operating leases, you're talking about 15, 20, 30, 40, 60, 70, 80+% of assets. So one quarter to the next, 50% of the assets are gone. What? And nobody else has to worry about this, by the way, because no one's building out economic earnings models at scale.
Right.
All the accounting data they want you to see, that's there. That's in the earnings release, right? Which is a subset of what you get on an income statement. So we had to go in and say, well, shoot, what do we do here? We looked at a lot of different models, and ultimately we decided on, okay, let's just assume it was the same as it was last quarter. We're not going to try to predict that it's the same percentage of assets or this or that, because those models, honestly, they just don't work very well because there's so much variation in what might change from one quarter to the next otherwise. But we have a huge piece of code in our system, maybe the most complex piece of code. It's called estimator code. And its sole purpose is to figure out what to put into the model when required disclosures go missing.
Wow. So why isn't I'm going to blank on the organization that kind of handles the accounting and things. Why isn't this a bigger deal, and why do we let the companies get away with this?
I've asked the SEC and I've asked FASB the same question. And FASB will say, we don't enforce, we just make the rules. So it really falls to the SEC. I've been to DC a few times to talk to the SEC about this. And I've even said, hey, listen, I'm happy to let you use my technology. I remember the last time I was in DC was before after the great financial crisis. And I met with the SEC, the Senate Banking Committee, and a few other folks, and said, look, our system shows that in the last several years, we've probably seen 300 or 400 balance sheets that don't balance and 200 or 300 income statements that don't add up. These are not rounding errors. There's major stuff there. Thousands of filings where required disclosures just go missing. And we can find this all automatically for you. And the idea would be that people you have that look at this stuff, would do other things because technology can do this for you.
Mm.
Their reaction, anger, that I would propose that a machine could do anything that potentially replace some of their people. That was, 10 years ago, plus. So yeah, I don't know what to say. That's what happened. So that's one of the problems we have. I think this is one of the reasons I'm hopeful for Doge. I don't know how much, I don't have like a lot of trust in Elon Musk per se, but please, we know if we don't fix spending, we're hurting as a country for a long time. And I've been face to face with folks who are getting paid a fair amount of money who are purposely, deliberately underproductive because they just want to save their jobs. And I think that's the mentality that has been growing for a long time. Anyway, sorry, I got off subject there. I don't know why they don't. It's not a priority. Look, the other thing to keep in mind, I point this out to a lot of my institutional clients always, is that when you kind of look at the talent, the spectrum of talent out there, the smartest people are going to go work at the hedge funds, the quant funds, right? And after that, you got mutual funds. And after that, you got Wall Street sell side people. And after that, you got consulting firms. After that, you might got corporate America or whatever. I don't know. It gives really smart people in corporate America too, right? But pretty close to the bottom of the list, typically, if you just want to look at pay, you've got folks at the SEC. And so you're just dealing with typically a group of people who are underskilled compared to their Wall Street wizards. So they're just going to be struggling to keep up. And yeah, I don't know what to say. I think they Wall Street, they just run circles around them. Occasionally they close a loophole, Wall Street creates a new one. The operating lease loophole was partially closed, better than when I helped write that rule for FASB. Partially closed. There's still a little bit of a loophole in it, but you know what they created in order to keep more debt off balance sheet? A new type of off balance sheet lease. It's called a not yet commenced lease or a variable lease. So yeah, Wall Street doesn't want you caring about it. Let's think about who the vested interests are, right? Who makes money when the market goes up? The media. They sell a lot more commercials when the market's popular than they do otherwise on CNBC, right? Wall Street wants things to go up because they're making money, more and more money. They're trying to lure more people in. So, who wants to throw a wet blanket on this earnings party and everything looking great? Who wants to talk about how, maybe these financials aren't as reliable as you think? You think that helps Wall Street get more IPOs done or less?
Right.
So it's there's significant conflicts of interest. I don't know that everybody's aware of how thick, how strong, how huge the conflicts of interest on Wall Street are. I mean, having gone through the tech bubble and been at Credit Suisse, which was the biggest IPO tech firm on the in the world at the time. I mean, I saw horrendous conflicts of interest. It was upsetting, it was startling. But then there was a huge settlement that busted Credit Suisse and some other firms for this conflict of interest, the global research settlement, championed by Elliot Spitzer, who's now famous for other reasons. But it was the biggest ever settlement won against Wall Street. It was $1 billion. You know how much money Wall Street made in a week during the tech bubble? Probably $1 billion. So the punishments don't really fit the crime. The SEC is, I think, in many ways more beholden to Wall Street than not. They're going after other things like front running and other sort of more egregious crimes. I don't know how well they even understand accounting. Wall Street's going to, they're going to just keep pumping it. So there's not a lot of incentive for people to do that. And I'll be honest, like when I was on Wall Street, that was my job. And that's what I kind of grew up on Wall Street doing. And I loved it. And it was before the tech bubble, and Credit Suisse was a huge supporter of it up until Frank Quattrone joined the firm. When Frank Quattrone, who's probably the top tech investment banker of all time, at least he was until recently, and he was for sure back during the tech bubble. When he joined the firm, that's work I was doing to build economic earnings for all the companies under coverage at Credit Suisse, and we were close to like 80% of the world at that point. I can't tell you how quickly that took a back seat. Mobison and I made it so like you couldn't get on the morning call if you didn't have like a value dynamics framework model that I'd created to talk about, because we trained the analysts, said, look, if you're not going to talk about return on capital and expectations analysis, we don't want you talking about the stupid stuff, because we're past that. Can't just talk about earnings and PEs. We're past that. And then Quattrone's team joined, and we tried to hold the line for that for a little while. Got a call from the big man, Brady Dugan. Basically, what the hell are you doing? Let these people make us a lot of money. They did. They made a lot of money, but yeah, we got pushed to the back burner. We got swept under the rug, and it's never changed since. And I felt like, look, if Wall Street's not doing the work that everyone thinks Wall Street's supposed to do, you know, I felt compelled, obligated to go do it. And I knew I needed the technology to do that, because you can't find people willing to do this work.
Right.
Takes too much time. That's why you guys have a business, right? No one else is teaching people how to talk about return on invested capital. I should ask you the question.
No.
You tell me, why do more people care about return on invested capital?
Yeah. I think you nailed on, pretty spot on.
Yeah.
It's not exciting. It's kind of boring. But what we offer is a free ebook and email series at stockmarketpdf.com. So tell us about New Constructs, what you built. And one of the conversations I had with you, you mentioned like having this idea at your apartment, like way back in the day. So I'd love to hear that story if you don't mind.
Yeah, I was doing this work at Credit Suisse. We were doing it all manually. Everything's in Excel files. And I ran into two hurdles. The first was the technology folks at Credit Suisse taking these Excel files that were all templates, all like the calculation pages were locked down. So all the data was in the same place. And I said, so let's put these into a database. That's the dream. Like, that's the coolest thing about my platform. It's like I go and screen for any sector, subsector. I'll show you the best stocks, the best ROIC, the worst in a second. And it took like 5 or 6 months before the tech people came back to me and said, we can't do that. I was like, what do you mean you can't do that? Like, well, there's an error in one of your models. I'm like, oh, okay. Well, tell me which one. Like, oh yeah, we can't tell you that. And that's when I was sort of like, oh, wait a second. I did enough coding to understand that at the end of the day, right, everything gets boiled down to a stream of ones and zeros or a single file line, which means you know exactly where the code breaks or where the problem is. And when they not only weren't willing to tell me that, couldn't tell me that, but were willing to assume I was so dumb that I didn't understand that, I was like, oh my gosh, okay, take a step back. This isn't going to happen. And then the next thing was Quattrone and those guys joining, everybody talking about the tech bubble or tech stocks, and having meetings with analysts on the tech team who literally said to me, Dave, what? Working capital? Balance sheet? You're wasting my time. I got to get this IPO out the door in the next few days. I don't have time to talk about the balance sheet. Who cares? See you. Right? Those are the kinds of meetings I had with this with what was now more than 50% of the equity research department. Before that, nobody said anything like that to me. Nobody would say, oh, I don't care about the balance sheet. It was an awesome pitch when trying to convince analysts to use my model, because all I was saying, do more of what you're supposed to do. And I'll help you do it. So we had awesome adoption and momentum of everybody using this return on invested capital model. And then it blew up for those two reasons. And I knew how hard it was for me to hire people for my team even before the tech bubble. People would call me, oh, you're a database nerd, when I was doing this kind of work before, because I wasn't like a fancy high-flying analyst out there, making buy recommendations. I was kind of behind the scenes doing this work. And I thought to myself, gosh, if it's hard now to do what I'm doing at Credit Suisse, and I really can't even do it, what's going to happen in the coming years? No one's going to do it. And if the Wall Street analysts aren't doing this work, then who is? No one's doing it. And it just occurred to me that the market would be missing footnotes in a big time way. And so I figured that there was a way, if there was going to have to be a way, you'd have to create a new technology to do it. And that's where the seed was was planted. And I did like do my best to help Credit Suisse be successful. I wrote a business plan for Brady Dugan. He gave me a $25 million budget to go implement my platform around the world, make it from a proof of concept into a real business. And the proof of concept is when the global head of research at Fidelity said he'd pay us several $1 million in hard dollars to have access to this product I put together, which was all just a few models at the time. But he the global head of research at Fidelity, a guy named Bruce Herring, he understood it, he got it. And I gave Credit Suisse the roadmap to do it. And when they couldn't do it, I was like, all right, I'm going to do it. And I knew they couldn't do it when they decided to buy Holt Value Associates, because my primary competitor before they bought Holt had been Holt. And our differentiating factor was, well, Holt's just taking a CompuStat data feed and running it through models. Anyone can do that. The value dynamics framework or the Credit Suisse product was all about, hey, no, we're going through the footnotes. We're giving you the real data. Mm-hmm. And so when Credit Suisse gave up on that entirely, and I knew they could fully capitulate and given up when they bought Holt, well, that's when I decided to start New Constructs. I wrote the business plan out of my apartment in summer of 2002. And the main thing was really to create a new technology to go get the data out of the footnotes with greater speed and accuracy than a human could do it, because I knew I couldn't find enough really smart people to do that kind of work for long enough to justify training them, because it's tough work. So it's always been about the technology. And over the last 20 years, we've really perfected that technology. It's gotten better and better, which is why we cover 3,400 companies now. We're probably covering at least, by the end of the year, we might be covering the entire world, depending on certain partnerships where we're looking to scale out coverage. But 90% of all the filings we can automatically parse, because we've got hundreds of thousands of meticulously marked up filings telling the machine how to handle all these different scenarios. Now, we're still going to use humans a fair amount, but it's only when the machine's like, I can't figure out how to handle this. And I've got 250,000 scenarios for this company in this sector. None of them apply, so I don't know what this is. And then we add another scenario. We say, oh, this is what you need to do. So every time we fix it, it gets smarter. And we've been iterating on that for 2 decades. And so it's a really smart system. It's for the benefit of the listeners, it's been proven superior by professors at Harvard Business School and MIT Sloan. They wrote a 70-page paper proving that the data that we collect is better than anything you can get from S&P, Capital IQ, CompuStat, all of that. There's another Harvard Business School paper that proves that our stock ratings are superior. There's an Ernst & Young rating that proves that our return on invested capital is superior to both Capital IQ and Bloomberg. If you're familiar with the business, you won't be surprised to hear that, because you know that the data from these legacy data firms is all pretty bad. But yeah, that's the story, Andrew. I felt like I had an obligation to do what I knew needed to be done, because the integrity of the capital markets might someday depend on it. And that was the title of my business plan: improving the integrity of the capital markets. New Constructs, improving the integrity of the capital markets. And I think we've done that. The Harvard and MIT paper proves that the market is missing footnotes. And so for our clients, we give them access to data that no one else has. The Harvard and MIT paper also proves that there's idiosyncratic or novel alpha in that data. So there's an advantage to those that have better data. And I think now is a great time for the work you're doing, for the work I'm doing. I think we're entering a golden age for the stock market that we haven't seen probably in a couple of decades, where capital is going to be allocated to where it's most deserved, which is undervalued and profitable businesses, because it's been over allocated to the expensive stocks for so damn long. At some point, it's going to flip. But I think, the rattling of the cages we're seeing now, internationally, domestically, everything, it's going to cause a shift, I believe, and we're going to see capital flow to the overlooked, unrespected stocks in a way that it deserves to have been going for a long time. And it's going to come away from, the Mag 7. They're like such a disproportionately large part of the market. It can't get any worse, can't get any bigger. People are already starting to chip away at NVIDIA and some of these super high valuations.
Yeah. And as a user of your platform. I'm in there probably almost every day, and I'm just scratching the surface. It's really incredible. Everything that is in the platform, what the tool actually does. I mean, the footnotes alone, it's it's hard to describe on a podcast, but you can go in and you can click and it'll take you right to that spot on the footnotes, and it's all organized. And one of the, me being the ROIC nerd, one of the nuggets that I liked discovering was that as part of invested capital, you included previous impairments. And I'm like, yeah, how come nobody's talking about that either? And your model is like automatically including that. So to your point about being like the most accurate ROIC, most in depth with footnotes and everything, and ease of access, I love using that platform, and I think it's a great service to the entire investing community.
Thank you. Thank you. Now that's my goal. And those features you point out, we've had those in there for 20 years. And the reason is that, look, if you're going to do something like I'm endeavoring to do here, you need people to trust it, because you guys probably have seen a lot of people talk about ROIC out there, right? There's a guru site, there's like 50 sites, Morningstar, FactSet. We've got studies on our website where we go in and compare the Morningstar ROIC or the FactSet ROIC or anybody's ROIC to ours, and it's very different. And it's clear they're missing stuff. But the problem is you don't know how they get to it. They won't show you.
Right. Yeah.
So I very purposely built in perfect transparency, complete transparency into my system, because I want everyone to be able to validate, to audit every single number. Every single number, because if you're doing it right, you should be proud to share your work. And I want people to use new constructs as like a barometer. Like, hey, if they're showing it, why does this other firm show it? And that's the only reason why you got Harvard Business School, MIT Sloan, the Journal of Financial Economics, Ernst & Young. These are prestigious institutions whose reputations matter more than anything. They're not publishing papers saying your research is superior if they can't prove it to their own peers. And that's the point of all that stuff. There's 100% transparency, so you can prove it to yourself or prove it to anyone else, because we have done the work. And when we say we're delivering the truth, that can be audited. And if someone's not willing to be transparent with you, you might not want to trust it.
So can we take this thing for a spin for our audience?
Absolutely. Absolutely.
We have something special for the listeners. This episode's going out on Sunday the 16th. So actually on the 19th, a Wednesday, on our YouTube channel, we're doing something we haven't done before. 10 o'clock a.m. Eastern. We are going to live stream on our YouTube channel, and David's going to take his platform for a spin so everybody can see it firsthand. And I'm excited. I think
I am too.
it'll be a lot of fun.
I am too. It's going to be cool.
Yeah, it's amazing. I mean, you put a ticker in it, and it's all right there, and you can click through all of that. So we appreciate you sharing that with the audience, and I highly encourage people to come, because I think that will be a very valuable thing.
Yeah, it's going to be exciting. It's going to be exciting. It's fun to show it, right? I mean, it's people. You want people to see it and believe it, and we enjoy showing it. And it's always insightful. It's really fun. We were joking about that quantum computing stock with a surprise ending. You think they look super expensive, then you know what? When you have a database like ours, you can benchmark what the cash flows look like compared to other really successful companies. So if the quantum computing company's stock price implies that it's going to be twice the size of Walmart's revenue, when you're like, oh, maybe that's a little too much. On the other hand, if it shows it's going to be like ranked number 400 in the S&P, you're like, well, this could, if this is truly the quantum computing company, maybe it's cheap now if it becomes the quantum computing company that people think it can be. And all that stuff is super important. And it's not hard to do this kind of analysis. It is hard to get the data right.
Yes.
Well, you've shown a couple examples of maybe it's Beyond Meat, and I can't remember the other ticker, but it's like, oh yeah, the company needs to, no big deal. They just need to grow their ROIC from like 5% to like 300%. No big deal. And then the valuation makes sense. I think it's funny to have those illustrations, but it really is out in the market today. Some of these stocks are just insane.
It really is. They are. We were just doing an earnings call today, and we were looking at DoorDash and Lyft, and both of those stocks to justify their current valuation have to have profits and ROIC in the top like 3 of the S&P 500.
Like
Revenues
1, 2, 3.
10 or 11. Correct. Yeah, and the top 3 right now, when we start talking about the top firms in the S&P 500, you're talking about some like really good businesses like Microsoft, Google, Nvidia, Meta, Amazon. Those are the top 3 ranked on NOPAT, operating profit after tax.
Right.
Or those top 10, right? JP Morgan, Exxon. I think we're looking at implied NOPATs, right? But then if we do it by return on capital, you're also talking about some amazing businesses. So yes, these stock prices imply they're going to be an amazing business and have huge revenue. And it's maybe one or the other,
Right.
but both, come on. And it's not to say that they won't do that. The point is, to own the stock, you got to believe they're going to do better than that. Because there's no reason to own the stock if it's not going to go up. And for it to go up, well, then the future cash flows need to be even better than what's already embedded in the stock price.
Mm-hmm.
Yeah, and that's the power of the reverse DCF, which is what you're going to be showing for our audience, and we'll do a couple stocks in there. So we really appreciate your time, David. I know there's listeners out there who are listening to this right now, and they want to check out your stuff right now. They can't wait for the live stream. So where can people check out your platform and everything you're doing online?
Yeah, just go to newconstructs.com, click on the blog, click on the free trainings, the free e-letters. There's a bunch of case studies in there that we've published that I'm happy to share. We've got one on Amazon that's shocking. I mentioned a quantum computing stock, Rambus, shocking. Like, just when you run the numbers out and you do the diligence, you're going to be surprised. And the reason these anomalies exist is the same reason why earnings are misleading. Nobody's looking at this stuff. Nobody's out there. You don't hear Dan Ives talking about the expectations baked into Nvidia stock price. You know why? Because to justify that stock when it was at its peak, its revenues had to grow to like the size of Japan's GDP. And no one wants to try to make a straight-faced argument for that. But guess what? You're not going to get the banking business if you're not bullish on the stock. So you've got to find a way to be bullish. Otherwise, they're going to say, "Oh, you don't like us? Your analysts aren't saying good things about us." Well, sorry, you're out. You're not going to be part of. We're not going to do any investment banking business. We're not going to let you sell any more debt, sell any of our debt, or sell any of our stock. And that's ultimately how these firms make money. They don't make money selling research. You know what the percentage of revenues that research make up are at a Wall Street firm?
Mm-hmm.
It's like 0. It's all investment banking and trading, right? Mostly investment banking. So if you don't do what makes the investment bankers happy, off with your head. Yeah, newconstructs.com. Click on the blog tab. There's a ton of free research there, free trainings. I got my e-letters. Those are all free. There are a bunch of reverse DCF case studies there. If you want to go a little bit deeper, we have a community on Circle called New Constructs. It's free to join. You just got to fill out a form. And yeah, those are the best ways to get in touch.
Awesome.
Thank you very much, David. This was amazing. I could probably talk to you about this stuff for like maybe another 3 or 4 hours. So I'm looking forward to our conversation on Wednesday and having a front row seat to seeing everything that you're doing. I've only gotten glimpses of the platform, and I've just, every time Andrew shows me, I'm like, wow, this is amazing.
Thanks, guys. I've had a great time. I'm looking forward to it too.
Awesome.
Sweet. Well, that's going to wrap us up for today. We hope you enjoyed this show. We will see you on the live stream. Connect, learn, and grow with Value Spotlight. Peace.